I mean,
Yep.
like you think about it, like just like 3 or 4 years ago, nobody ever talked about SerDes. Like it was there, and now it's like everybody's talking about SerDes. Who has the best
It's all
SerDes?
cool again.
It's
Everything.
everything. Like I mean, we're gonna be how long until we're sort of debating who has the best flavor of silicon wafers?
Not long, Jay. This
Who's
is my prediction.
I don't like those Ajinomoto substrates. I'm gonna get them from somebody else. The Ajinomoto ones have too much MSG in them.
Not sustainable enough. Not manufactured responsibly. Hello, everyone. Welcome to another episode of The Circuit. I am Ben Bajarin.
Greetings, programs. I'm Jay Goldberg.
All right, so let's start it off with what I think was probably the main news of the week. Marvell had a custom semiconductor slash custom ASIC event on Tuesday. It was a webinar. It was positioned as an investor webinar. But the reality is, they've been silent on this topic for a while, and the stock reacted pretty positively. I think 7-ish% the day after. Obviously, everybody wanted to hear kind of their take, right? Broadcom's sort of been sucking up a lot of the air on what's going on in custom and semi-custom. So it was good that they weighed in. It was surprisingly long, much longer than I thought it was going to be, but there was a lot of very good technical presentations. I think one thing they really tried to do, and I appreciate their effort here. I'm not sure they landed on it 100%. Was really try to explain their technical differentiation, especially compared to Broadcom. I think that was a valiant effort. I'm glad they did that. They went into some technical depth on across their product portfolio, stuff they're doing in SerDes, stuff they're doing in advanced networking. But bottom line is they see meaningful revenue to a handful of billions of dollars that they upped their TAM, their opportunity TAM as they see it, and I think some of those things are what reacted positively.
Yeah. So I didn't listen to it live. I read into it later, and I think you're right. It was good. I think we've said this pretty consistently about Marvell is they have a pretty deep pool of technical talent, and so when they really turn it on, they have a lot to show. It's interesting. They have a pretty good framework for explaining it and making it digestible. Um, and I, and I think that's to their credit. Um, the street did seem to like it. That's good. The thing I keep coming back to though is the business side of custom is lumpy. Let's call it lumpy. Um, Painful, heavily cyclical is another way of putting it. But lumpy. We'll go with lumpy. Uh, and I think they're gonna have a hard time ever convincing the street that's not the case. Um, like I've talked to a lot of investors lately about Marvell, and we're all like, sort of throw up our hands and shrug. Like nobody knows. Like what's the situation with the next Tranium? Like at this point, is it Alchip? Is it Marvell? Is it both? Are they both? Amazon string them along?
Yeah.
Probably. And and that's like it's just not a good conversation to be having. Right. And so this is a good chance for them to talk about something else. Like, hey, we do all these great technical things.
Yeah. Yeah, and I think I was talking to some folks about this too. Their line of sight to revenue pipeline. I mean, I think it's a legitimate number because these ASICs that they do with Amazon or Microsoft or whoever, right, take 2 to 2.5 years to tape out. So like they know essentially like what the scope is. Now again, those aren't booked dollars, and I'll clarify this in a moment. But if Microsoft comes to them and says we need, 500,000 of our accelerators, and we're going to build that out and scale it over this timeline, like that's going to be committed, right? Dollars that are on paper committed. Now, I do think, and this to me, there's two parts of what I'm about to say that are really, I think, the not just the lumpiness that you referred to, but kind of the downside case for both Broadcom and Marvell. And I say this with the exception of everybody but Google. Most of those projects have to fit a analysis of either TCO or amount that they believe that they can monetize above their cost in order for them to go forward. And that's not something that they know when they first skep that project out, right? They tape it out, they'll start testing it, they'll run those workloads and say, is it going to hit our performance per watt or our tokens per dollar per rack or whatever? And they don't initially know that. And until they know that is when they decide to scale. If they don't scale, meaning that they don't go and turn this into a tens of thousands of cluster, program, then that's revenue that's not going to come to said vendor who's doing custom IP for these tape outs. So I say that to say, while yes, they would have line of sight to revenue, and this is both Broadcom and Marvell, there's really no guarantee there. It's not like we've won this, book this revenue, that's our size. And I think that distinction has to be made.
Yeah. In fact, there's another wrinkle that I would add to all this, which is one of the difficulties that companies face in dealing with the hyperscalers is you want to sell a chip to a hyperscaler and you're planning it out multiple years in advance because it takes time to design, then you got to tape it out and all that. So it's call it 2-year product cycle from napkin to getting first silicon back. As you're designing it 2 years in advance, you need to know, like you said, the ultimate performance of that chip depends heavily on what workloads are being run on it. And if you're doing merchant business, the hyperscalers do not share their actual workloads with you, right? So you don't actually know what the performance can look like. You can, I mean, most serious companies today have really good chip design teams. You can design it, you figure out what specs you want, and you can zero in it and get that performance back from. It'll be at the clock rate you want, and within yield bounds, and like you can design it to spec. The problem is you don't know what the actual needs of the customer are. Right. And so in theory, in the custom side of things, that part of the decision making is actually done by the customer, right? Like the hyperscaler will design the chip, and so they know what their workloads are. They can do it in simulation and run it in a way and know what their performance is and design it accordingly. So but I'm not sure that's actually happening here, right? Because I do think Amazon in particular is playing all chip off of Marvell. I imagine the others are doing that in other places as well. And it's unclear to me how much information they're actually sharing. And so I think that makes it, we're in a weird position for these custom chip designers where they should have more information than they actually get, but they probably don't. And so it's extra difficult. And then the other thing to remember is even once you get first silicon back, it's can be 9 months to a year before it actually gets into production. They got to evaluate it first, and that will take a long time. And so they're talking about chips now that they're signing deals for chips now that won't be in revenue for 2, 3 years, 4 years.
Yep. And the other variable here is, the dirty little secret of everybody in the cloud world is that they still do actually run a sum of, obviously not necessarily the majority of, but some of these workloads and internal workloads still on GPUs. Like it's a little bit of a hybrid environment. And so they haven't completely ditched GPUs, and everybody that you talk to, right, who builds out these data centers from the cloud guys will say, sure, we love our ASIC business, but at the end of the day, we're constantly evaluating that against merchant GPUs or merchant ASICs as well to determine. And I say that to say what would happen if in 12 months somebody, let's just say OpenAI or somebody, right, drops some new breakthrough and you couldn't have designed for that, right, in your ASICs. What could handle that is a GPU because it's more general purpose. And so if that happens, barring any software innovation, it's just such a big unpredictable. It's like, what I can tell you this though, Jay, what I guarantee will continue to run well on a roadmap is GPUs. like I can tell you, yes, they may be constrained on workloads, but they're probably going to outperform any variable that happens because they're more general purpose. That's a guarantee. ASICs are not. And that's just why I think this is important to add to this conversation. Again, going back to this debate we've had numerous times on this show about just understanding the relationship between GPU and ASICs. And when somebody comes out and says, ASICs is going to be $100 to $100 billion TAM, yeah, on paper, but a lot could change, right? They could change that. What I can tell you is GPUs are going to continue to grow as a part of that TAM. Like, that feels relatively certain. And I just think those dynamics have to be, factored into this.
I mean, that's exactly Jensen's argument, right? He made
Yes,
the exact same
correct.
case all the time about Merchant, made it at Computex. The
Was I more eloquent though? That's my question. Did
you,
I
are you more
maybe did?
eloquent than Jensen Huang? You're very eloquent, Ben, but you're not. No, you're not more
All
eloquent
right.
than Jensen.
All right.
Maybe
All right.
you need the leather jacket. Um, but here's the thing: the risk that the other side of that is, of course, if you do it right, say like Google, the gains are immense, right? You have
Yes.
so much
Right.
leverage when you do it right, and
That's right.
it's really fascinating to me to watch the hyperscalers permeate through this, or right, trying to figure out what it is they want with silicon. And I think it's weird to me because I think Google's obviously done well. Amazon, I think, has done a pretty good job, certainly with Graviton, and they seem to really like what they're doing with Trainium because they're doing another version of
Yep.
it, or another two
Yep.
versions of it. Uh, it confuses me that Facebook is so far behind, right? And
Yeah.
I was actually talking to a bunch of people this week about this. They have such a compelling use for it. They know exactly what they want to do with it. I think they're like they're the like ideal customer for doing internal silicon, but they have a couple organizational problems, which likely means Mark is micromanaging things, but also they don't have their software stack down yet, right? But
Yeah.
so it's the market's a little weird. Like, I don't think Amazon and Azure make great. I don't know that they're going to be in this market long term doing their own, because all the things you just laid out about why Merchant is better, really for them is like just go with Nvidia and some AMD.
Yeah.
But it's all backwards, right? Amazon shouldn't be doing this, but they're doing well, and then Facebook should be doing this, and they're not doing well.
Yeah.
It's confusing, and I guess we're at the point where, at this moment in time, nobody gets fired for buying Nvidia.
Exactly. That's exactly right. The other part I think is just worth mentioning for anybody who's, tracking and analyzing this business is whoever is deeply serious about custom. And again, I think you're right on your priority list, right? If we just went down number one, Google, two being Amazon, and the rest kind of being like a question mark about how deep they'll go. Um, you would have to imagine that they would want to acquire and get more of the capabilities for the front end design services, which is the most expensive part margin wise with Broadcom and Marvell, and try to do more of that themselves, which would mean that maybe they don't need all of the things that Marvell and Broadcom bring to the table. They're happy with Alchip, or if GUC can continue to, be a player there, because they don't want to make those costs, right? Because again, anywhere you can save in margins with your custom, silicon, the better returns you're going to get in monetizing that through whatever it is, tokens per dollar, tokens to watt, et cetera. And so then the question is, can Marvell or Broadcom keep up these margins in front end design that they have when your biggest customers might be, wanting to acquire more of that IP so that they don't need to pay you for as much work? And I don't have an answer to that. I'm just throwing that out, but that's a dynamic I think, we got to watch.
You see, I think about it differently. I don't actually think that's the right way for them to be looking at this. I think if you're designing silicon because you want to save some margin, that will fail. Ultimately, that will fail, right? You just want to, you don't want to pay Nvidia's margin. The amount of money it's going to take to get you there is immense, and so the cost at a sort of mathematical level, the cost is break even. And then, especially in the volumes we're talking about, right? Because you have to spend $1 billion to design the chip in the first place, right? It doesn't mathematically pan out. Where it does pan out is where you can get leverage through software, get leverage through strategic advantage, where you're driving something else. Like, I always point to Apple as the best example here. Apple Apple Silicon they're good chips, but like, they didn't do that because they wanted
Yeah.
to cut out Intel's margin. They did it because it creates better products, better phones, better computers, that means that consumers are much more likely to buy. And so spending $1 billion generates, tens of billions of dollars a year in extra revenue. That's where it's worth
Yep.
it.
Yep. Yeah. I mean, I think they do need to squeeze out wherever they benefit, wherever they value efficiencies from. My only point is there's a cost number, right, in any of this TCO where once it gets above a certain amount, it's like, yes, go forward. And if they had less margins, if they paid less margin, that number is lower, is my only point. And that, again, may or may not happen, but I think it's worth if Google makes like a big IP play, for example, for some reason, who knows? I don't say they won't, but say they do, maybe they don't need 3/4 of the things Broadcom gives them. They need 1/4. And does Broadcom care about that? So it could have economic impact if something like that happened, but it may not.
I think, yeah, I mean, there are all kinds of questions around, like, what do we really need the custom ASIC providers to do? And I think this is where it gets into the technical weeds a lot, right? Why is it that Broadcom
Yes,
is so much better
that's
than
right.
Marvell? Because it's not really. Once upon a time, this was all sort of back end design stuff, but it's different than that now. It's a lot about IP and Broadcom SerDes and, like,
Yep.
I mean,
Yep.
like, you think about it, like, just like 3 or 4 years ago, nobody ever talked about SerDes. Like, it was there, and now it's like everybody's talking about SerDes. Who has the best
It's all
SerDes?
cool again.
It's
Everything.
everything. Like, I mean, we're gonna be how long until we're sort of debating who has the best flavor of silicon wafers?
Oh, man. Not long, Jay. This
Who's
is my prediction.
I don't like those Ajinomoto substrates. I'm gonna get them from somebody else. The Ajinomoto ones have too much MSG in them.
Not sustainable enough. Not manufactured responsibly.
Yeah.
Oh man. No. But you're right. I do think this factors into, again, right, just making decisions on what they want to do and what they're happy to outsource. And my point is, if you just, again, and Alchip has a lot of capabilities. They just partnered with Astera Labs this week on some acceleration for networking, which is smart, right? Because now Alchip's going to go to those customers and say, oh, well, look, I can do custom stuff for your networking, kind of the same way that Broadcom and Marvell has done. So at a less margin, again, right? They are not trying to do 60% margins. They are the lowest of every player. Now, that might make this go up some. My guess is they want more of that margin, but they don't need to be north of 50, 60 like Marvell and Broadcom. So that's my only point. Like, could somebody else come out with margins if a hyperscaler doesn't need as much IP? But again, we don't know that. It's just, that to me is somewhat of a risk, maybe less of a risk, but it's one risk to watch.
Yeah, it's always going to be out there percolating around. People are going to be concerned about it, and there's reason to be concerned about it. I think you're right. It's gonna happen in some cases. Customers, the hyperscalers at some point are going to want to do more on their own. They always do. It's weird to me. The hyperscalers have this weird drive to do everything themselves. I think that's their instinct. They want to do everything themselves,
I agree.
even when it doesn't make
Agreed.
sense. And so there is this big risk that I think that's part of what's going on with Marvell and Alchip is Amazon looks at it and is like, we can do that part, and maybe they can, and maybe they can't.
Yeah, exactly right. All right, so let's shift into kind of my thesis I'm working on about the next phase of the semiconductor industry. Now, I'm loosely sort of calling this 2.0. I know we could argue that there's a number of things, but the reality is we are on a growth trajectory that I don't know if we have really seen a scale like this before. And part of the reason that I say this is 2.0, right? I've thought about this more since we've talked. So here's where I've landed, is because I think we've got kind of two moments of time where software workloads dictated compute gains as a necessity because software was outstripping compute. And that was the first Intel Pentium era of just obviously local software, enterprise software, Windows, yada, yada, yada. And then now there's this one, right? So AI is driving this cycle where you just go, look, we've got runway of software and we cannot keep up with that. And that's what's going to drive the whole industry. Now, again, the growth I'm talking about is not just going to come from that, right? We've got robotics, we've got automotive, we've got, you know, other things that are coming to the table that's just driving microprocessor needs to be in every device. But this is the workload that's causing this new S curve in the industry. And then also similarly, I was looking at this, like, foundry TAM is set to grow now anywhere between 14 to 18%, depending on somebody's numbers. But the reality is capacity is growing. The last time that happened was a period before, again, the one that I mentioned, right? Intel following Moore's law, scaling out foundry capacity so software could, you know, meet the demands. And so that's why I kind of have it in these two buckets of what drove this cycle. And an interesting point I've heard a couple people make, which is, you know, I think by 2030, the estimates are the semiconductor industry will be $1 trillion industry, right? For as long as this has taken, 40 something years. But then most people believe it'll only take around 10 years to go to 2 trillion. And I think that's just showing where we're at in this ramp. And then the middle point is what separated us, which is also why I go back to the workload point, was this kind of lost decade where software really wasn't really pushing devices to the limits. You could argue graphics were, but not software in kind of the mobile era. And there just wasn't a ton of IPC gains happening. There wasn't this race because software was pushing compute to the limits, and it was just kind of a lull. People came out with a good product, right? Every other year, it was fine, but it wasn't this like generational leap that was needed in that kind of Pentium growth cycle. And then again, what we're seeing in the GPU and the ASIC area. So that's where, to me, is how I'd kind of define these two eras that we're in, and why I would say this is like a 2.0 instead of 3.0, 4.0, or something of the semiconductor industry.
So I'm not going to give you the numbering.
That's fine. That's fine.
2.0. I feel like if we go far enough back, we'll find some other instance here. But I like the way you frame it as software capacities outstripping compute capacity, because I think that is the key thing. And I think we've had it other times. Mobile is interesting in that we were pushing. I think what happened in mobile was we were pushing hard against a different constraint, which was battery life.
Battery life.
It's
yeah.
like you have these gains from Moore's law. Where do you apply them to, right? And
Right.
in mobile for 10, 15 years, they applied it towards just making it cheaper.
Yeah.
And then Apple came along and said, no, we're going to give all those gains from Moore's law to the consumer, and now what we really care about is battery life. And so it was pushing in a different direction. I think here there's absolutely this case where the software is constantly changing, and yeah, it's a pretty noticeable effect here, where your PCs were probably happened with PCs. I think if you really insist, I'll go read through the history and I'll come up with something from the 1970s.
I don't insist. But the other thing I think you could use to factor into you is just the annual growth rate of the previous cycles being as high as they are. That now, again, right, in the Intel era was largely Intel and the ecosystem that was around Intel. This is much bigger. We have so many more people playing into this growth cycle and this ecosystem. It's literally it's everybody. You know, it's not just isolated to, it's everybody is capturing part of the value here. But I do think the reason I like the workload point is I think it's a good framing to talk about why we're chasing compute, why the little fine tuning things that we nitpick around, like even like some engineering conversations I've had lately, like the little things, like you mentioned SerDes. This is one part, like they're talking about just fine tuning, like this little tiny optimization that leads to this one little benefit in wattage or performance or networking throughput or something, right? Getting all caught up about this like one little tweak or architecture decision they made. And those aren't insignificant, right? They might kind of feel like it's one part of the stack, but it's all of this fine tuning that's constantly happening, that's leading to a range of these. And that's why I say it's just so interesting that every part of this ecosystem is kind of looking at these workloads going, we can all do better. Like we all have to do better to get to this goal, because it is such a big vision, and it's one that just requires a ton of compute, and it's not going to end. You know, this roller coaster is going to keep going for some time, and so that's why I kind of think of you could also say epochs. I know people we like to talk about epochs, like what generationally moves a fundamental industry to this entirely new, concept. I've also heard industrial, a 4.0, which I hate that term, but you see what people are trying to say.
Yeah, that's why I hate the
It's
number.
a generational thing. Yeah, it's a generational thing that's happening. Doesn't happen all the time, but when it does, man, hang on, because it's big, and that's what's happening again right now.
Yeah, I think we're still in the middle of it, and it's kind of tough to see because to some degree we're still reacting to the the deterioration of Moore's law, right? If AI software, if a few things were different, we could have done this all in CPU 10 years ago if some of this had happened, or if Moore's law kept going at the pace it had been going. But that doesn't work anymore, right? And so we need to start doing things different ways. And I think what AI is, and the shift to accelerated compute to GPUs, or not GPUs, whatever we're going to call them,
yes, let's talk about that real quick. Yeah,
it's a function of the software. The hardware is rising to meet the software, right?
Yeah,
we've sort of shifted, and we've shifted the dimensions of compute in a way that it matches that. If somebody comes up with a new form of doing AI that is not heavily reliant on neural networks, whatever that looks like, making it up, but like there could be a world in which suddenly microcontrollers are the dominant thing. That's not going to happen either. But you know my point.
Sure. Yeah. No, but honestly, a good example of this is that I think I've mentioned this before. In robotics, analog sensors are going to play a fundamentally different role to the execution of robotics in relationship to neural networks. Again, so that a robot can squeeze your hand or a piece of fruit and not crush it. Like there's a lot. In fact, I saw this crazy demo come out of a science lab the other day where somebody actually tied this 3D printed like sponge like material, it was very soft but say sponge looking, and into it was the sensor pad at the bottom, and every part of that foam sensor was susceptible to touch, like how much you squeezed it or how much like you're pressure sensitive from a foam 3D printed. Like I was like, man, that's a lot of analog sensors plus microcontrollers and analog to digital converters that go into making this thing so susceptible to the minutia, right, of sensitivity. And robots are going to need that, right? I mean, there's all sorts of things that's going to be needed. And that's just what completely changes in these cycles that I think is fascinating, is like everybody has to innovate. Analog shouldn't be boring anymore.
Thank you so much for saying that. Somewhere there is a listener, and you know who you are. Ben agrees with me. Analog is going to be cool.
Everything's cool again. The other thing I think is interesting, I'm curious on your take on this because I've actually debated this numerous times now with multiple people. So another rumor came out, which I think is reasonable, is that TSMC is going to again raise prices for 2 nanometer. And I was thinking about this because at some point, the way these prices go, like, I don't know if it makes sense for your monolithic players, and in that sense, I'm saying Apple, to be leading edge, because your gains you're getting year over year are not as big as the GPUs, right? The ASICs. And so I wonder, like how much of this is now going to skew to like really these big chiplet, these giant compute HPC providers are the ones that leading edge, not like your Apples and those before, because they're not going to see the gains aren't going to be worth the wafer prices.
You're not giving yourself enough credit. We called this 6 months ago, 9 months ago. I think we actually had an episode about it, because I know I wrote about it on my blog, which was this idea that TSMC wafers are going to $40,000 for
Yeah.
right? And what's
North of 40, yeah.
and I know we talked about it again in the context of like why Intel Foundry matters, because what's to stop if there's no Intel Foundry and Samsung doesn't get its act
Right.
together, then there's nothing to stop
Right.
TSMC's, whatever comes next. Those wafers go to $100,000. And I actually ran the math on what that would look like. And even at like 50, I forget the break even, but like it's around $50,000. It's not affordable for some pretty big companies like Qualcomm at $50,000 a wafer ish, 50,000 ish. Qualcomm doesn't go to the next node, right? At least not anytime soon, because it essentially erodes all their gross margin.
Yeah.
Right. And to your point, they're not, there's such little gain to be had from that.
Right.
So
and that's the new part of this that I've sort of come back to with again, like I get, right, Apple's a pipe cleaner for them on the monolithic side. They get a different type of a deal. Like I get that. But again, at some point in time, if you're only getting a couple percent, right, IPC gains or whatever, like fine, go get there eventually. But I don't think you need to be there day one,
no,
like they have been, right?
no.
And that's something I think will be super interesting to watch, and not just 2 nanometer, but below that for TSMC, because the costs on that are rising, and the analysis for it changes. And again, in this era of, like we're talking about, right, this big growth system coming to semis, the way monolithic thought about, right, their economics might have to change when you've got Nvidia and AMD and all the hyperscalers, right, building these high dollar chips. And it, for them, right, they can absorb that cost. It's not going to translate to everybody in the industry again.
Yeah, and there are very few companies that have gross margins sufficient to support that.
Yeah,
like
very true.
Right. I mean, already. I mean, that's one of the big pushbacks I hear about Nvidia is like lots of investors asking about their gross margins. Like Blackwell gross margins are lower than corporate average.
Yeah.
Right. At least
Although they say they're going to come back.
They said
they're going to come
they
back.
say they're going to come back, and that actually makes sense to me. I buy that, but still, it is noticeable that even Nvidia, who has these pressures on them. So what happens? Excuse me, to Marvell and Qualcomm and some of the smaller ones.
Yeah. Well, and a big challenge there, I think, is again, like how much I've seen estimates, which these chips are coming out in the next 6 to 8 months. So I believe them, of how much the chip increases have come in some of these merchant monolithic vendors in the past year. And they've gotten a lot more expensive. And who absorbs that? Like is your smartphone OEM going to pass that cost on? Do you have to eat those margins? Like this is not insignificant price hikes per chip in particularly, again, more higher end systems, but that's not insignificant,
Yeah.
So and that's because of, again, the entire ecosystem is charging more. It's become more expensive to produce these things, to compete. It's become more expensive to compete in monolithic, right? So you got to make smart decisions.
Yeah. And I think the answer to the question of who pays the cost of that, it's you and me. It's the consumer, in that our devices don't get better at a rate we're accustomed to.
Sure.
And maybe that's not the end of the world, but it's not a great thing either.
No. And honestly, like one of the things it's becoming a little bit more clear on at a technical level is when you look at a particular ASIC GPU or CPU SoC, you can get a sense very quickly of what size of models it can run on AI at the edge. And there's a possibility with what we're saying is that edge may be slow. Like you just may not be able to eke those year-over-year gains out in what you can do on device, and that slows down this whole thesis of you know what I mean, of what we're calling, right, on device AI. If they're not going to get those kind of year-out-of-year gains, or it doesn't make sense economically for them. Maybe they could, right, at 2 nanometer, but they're not going to pay those prices, and that's a real thing to watch, I think.
Yeah, I agree. I think it's a real concern, right? So, it's getting. I mean, and I think I actually said this in my note, is like when TSMC takes its wafers to $100,000 or whatever crazy number, that is the actual end of Moore's law. Right?
Yeah.
Right. Because that's when the economic gains stop coming. Now, to be fair, like we're still got lots of other levers to pull. to get better performance, and we see that in rack scale architecture from NVIDIA and data center scale architectures, things like that. But it's also what's driving chiplets, right? I was thinking about the other day is like chiplets are like they're like, first of all, technically it's very impressive, right? It's very impressive what you can do to bring all those components together, where you're mixing and matching different die in a way that they don't actually know that they're different die.
Right.
But in reality, that's just a poor man's solution, right? Because I'd much rather have everything monolithic. It's much simpler.
Yeah, exactly.
Right?
You just can't.
Right. So so the analog portion or the IO portion of my chip is going to be in a different, cheaper process. That's you buy your steak at Whole Foods, but you buy all the other ingredients at Food for Less.
Yep. Yeah, I mean, the reality is, right, as chips get bigger, you've passed the scale of what monolithic can do, and that's just a reality of physics at this point.
Yeah.
But it's driving, and that's why I come back to, like, if you just look at the prices within like 2 nanometer and beyond, right? If you're a chiplet provider, you can do some of that, right? You only need a couple tiles on 2 nanometer, so you don't need as many wafers. Right. So, like I said, it's a fascinating dynamic from what's going on, and the other part that I think is really interesting is I was looking at just the broader foundry forecasts and just kind of saying, it's unlikely that TSMC gets 100% of capacity over the next, 5 to 7 years. How much share is left over for, your Intel and, particularly Samsung as a part of a growing foundry TAM. But what gets interesting is, to add to this, like, what would it cost for, and in this forecast is assuming that capacity remains constrained, right? That people are still struggling, right, to get the chips that they need. What kind of CapEx would be needed to basically get to some form of parity where you can actually make all of the chips that would be want in the world over again a 5 to 7 year time frame or longer? But the reality is, if you're a foundry, you're generally more conservative, right? You don't want to overinvest and have stuff sitting there, and you can't predict these timelines. But it seems certainly clear that there's going to be still a demand issue for capacity in this, foundry TAM, that I think is interesting. But the reality is, my conclusion on this was simply that there will be dollars that a second and or third source, at least a second source, can go after TSMC, and they're not insignificant, but they're obviously not, hundreds of billions of dollars. And that's, reasonable.
Yeah. I mean, I haven't seen estimates for what 2028 CapEx would be, or how much
I haven't either.
But I know that if you look at the historical curve on fab cost, it costs about $20 billion to build a fab today. 20 by 2028, 2030. We're getting into the $30 billion territory.
Yeah, absolutely.
Right. Just stretch that curve out, and so that's a lot of money, right?
Yeah, and you're not going to spend that. And I mean, again, if TSMC knew that for 15 years this was going to be that kind of a run, I could see them doing it. But you don't know that. Like, you don't want to overbuild capacity. It's the worst thing you can do when you're a foundry manufacturer. So that's why I think people putting this anywhere from, the ranges I've seen of 12 to 18% CAGR for foundry is reasonable, because that would actually follow historical patterns of build out cycles. But, maybe all of a sudden somebody goes, hey, I'm going to spend a little bit more because I think there's opportunity, because at least for the foreseeable future, it's going to remain constrained. But these are such long timelines to build foundries, to build fabs. It's just too hard to predict.
Yeah. Yeah. But I think bringing it back to chip design and chiplets, I think we still have a few years to go. I mean, not like 1 or 2, but like 5-10 years, right? Because somebody else was telling me this week about the NVIDIA roadmap for Vera Rubin, then comes Feynman. I think Feynman is next.
Yeah.
And the power specs on that are just like crazy numbers. I mean, it's just
I saw that.
right? The TDP is it's like kilowatt per server per chip. You're just like, what? It's like it's a megawatt rack.
Yeah.
It's right, and like I heard that from somebody who does cooling, right? Who's in the cooling
Right.
business, and they're
Right.
like, we have the best cooling on the planet, and we can't like
No,
our stuff
not
is
even
not enough.
close.
Ours is not enough.
No. Yeah, in fact, there was Tom's Guide put out an article on this saying it could be, I think it was like 15,000 kilowatts per GPU, not rack, per GPU. And I was like, I don't even know how we support that, man. You
Yeah,
put 8 of those in a rack? I don't know.
yeah, yeah. It's
Yeah.
yeah, it's crazy big numbers.
Yeah. All right. Well, that's wraps it for us this week. Thanks for listening, everybody, and we will talk to you next time.
Thank you, everybody. Tell your friends.